You have any concerns given retail this morning, in particular Macy's, but across the board, sort of a concern there in some of these names, or is that not affecting your view of the overall equity market?
Well, we talked to our retail analysts this morning, and you know, basically the bottom line is the winners keep winning and the losers keep losing. So, you know, online, buy online and pick up in the store, those types of retailers seem to be doing pretty well. We have some of the big boys are going to report here, and we're certainly expecting some good numbers there. And you want to remember, like a department store, that industry group, I mean, that is a very, very small cap group within the S&P 500. So, you know, a number this morning, you know, a lot of retail sales, and it comes on the same day. You see an initial jobless claims number that's at 211,000. I mean, that is a multi-decade low. It is a great leading indicator. We have a very good jobs market. Wages are going up. We have confidence in the consumer. And if you look at it at a sector level, over the last month, the consumer discretionary sector has been the second best performer, relative performer. Obviously, it's been a rocky month, but you know, the consumer discretionary sector is definitely one we like and we want to continue to like.
It's interesting, Jeff. You get a big whammy like a Macy's today, and Dow's only down 63 points. Some of the groups in the S&P right now are turning green. I feel like if this happened a few weeks ago, we were in a market where any shred of bad news was just taken as a reason to sell, and a bigger picture concern about the U.S. economy and earnings and all that. Have we shifted here in sentiment where it's more of a glass half full kind of market instead of glass half empty, and is that significant?
I think what we have analyzed last year's significant pullback into Christmas Eve was how much of that was exacerbated potentially by tax loss selling, hedge fund redemptions, those types of forced sellers that needed to get out of the market, and then you throw on algorithmic trading on top of that, and you get some perhaps a very much increased downside vol, which we did recognize. Certainly coming into this year, the very fast reversal of that, a couple of breadth thrusts which have taken place earlier in this year in a market which seems to be a little bit more resilient as we begin 2019. So I think you're hitting the nail on the head, Sarah. Maybe not a real paradigm shift in here, but a market which discounted a lot of bad news in December, which is now looking up forward into 2019, seeing perhaps a more docile Fed, still strong overall retail sales, and a decent economic backdrop. And it's starting to use some of these dips to reposition themselves into risk assets.
Scott, resiliency, as Jeff just mentioned, sentiment change to a certain extent this year in terms of a bit more positive. You agree with that, and you think that's going to continue?
Well, we need clarity, and you know, I've been a guest on your show before, and we've talked for the last year about the two issues this year were fears about the Fed, fears about a global slowdown. So as far as we're concerned, the Fed's obviously talking more dovish. We'll hear more from the chairman today, but stocks were oversold. We've obviously had a big bounce since that Christmas Eve low. If you're a technician, you're probably watching this 2630 level in the S&P 500. We're probably not going to get through that on the first time, but overall, we see a good economy ahead here and abroad. We don't see much inflation. We think valuations are attractive. So, we've won our clients leaning the same way we've had them leaning for a number of years, and that's towards sectors like the consumer discretionary sector that are going to benefit from a continuation of this expansion. So we're positive. We think pullbacks are opportunities. We haven't changed our tune there, and I don't see us changing it anytime soon.